You know, in any earnings call, the prepared remarks, that's the script. But the real story, that almost always unfolds in the Q&A session. Today, we're digging into the tough questions that investors just threw at Teladoc and how their answers reveal a massive pivot for the future of virtual care.
Okay, so let's get right into it. We're jumping straight to the unscripted part of Teladoc's latest earnings call. This is where analysts get to grill the executives, and it's where we really get to see the challenges and the strategies that are shaping what's next for virtual care.
So, we've boiled down the key themes from that Q&A into 5 parts. The big questions investors are asking, BetterHelp's huge bet on insurance, what's next for integrated care, the company's financial situation, and of course, the final takeaway. Let's do it.
Right off the bat, CEO Chuck DeVita framed this coming year as a repositioning year. And you can bet the analysts jumped all over that. Their questions really dug deep into what that actually means for the business.
And what came out of all that back and forth was crystal clear. The company's entire path forward, it really hinges on successfully navigating some major fundamental shifts in these 2 absolutely critical parts of their business. So let's start with that first big transformation, BetterHelp. You probably know the brand. Well, Teladoc's well-known mental health service is running into some serious headwinds, and it's forcing a massive shift away from cash payments and toward an insurance-based model.
In the Q&A, the executives were pretty upfront about it. Their traditional cash pay business is being challenged. You know, in a tough economy, fewer people are willing to pay out of pocket, especially when competitors are starting to accept insurance. That really created a crucial turning point for them.
And this lays out the new game plan perfectly. Teladoc is trying to move BetterHelp from being a consumer product that relies on a ton of ad spending to a model that's plugged right into the healthcare system. The bet here is that even though they'll get less money per session, that'll be more than made up for by lower costs to find new customers and a much higher volume of users coming through insurance. And they are not wasting any time. This whole thing is being powered by their acquisition of a company called Uplift, and they're building out this new insurance foundation state by state. And look at that timeline. They want to be nearly nationwide by the end of 2026. That's ambitious. But, and this is a big but, let's keep things in perspective. It's still very, very early days. The company projects that this whole new insurance model will only bring in about $12 to $14 million in revenue for the entire year. That number really tells you just how new this strategy is and how much ground they still have to cover. Okay, so that's BetterHelp. Now let's switch gears to Teladoc's other major business, integrated care. This is their core telehealth service, and believe it or not, a very similar evolution is happening here. They're moving way beyond the simple subscription model. For years, the model was pretty simple, a subscription fee, what they call per member per month. But that is completely flipping on its head. The business is now shifting to a model where over half of its US revenue will come from fee-for-service visits. That means Teladoc gets paid only when somebody actually uses the service. Now here's the crucial part. Teladoc isn't fighting this change. They're actually leaning into it. The CEO explained that the strategy now is to make every single interaction more valuable and to create new kinds of contracts where Teladoc has some skin in the game, sharing in the cost savings they generate for their clients. So you might be asking, how are they going to add all this extra value? Well, one analyst did, and the answer came down to one word: catapult. This recent acquisition is all about finding and engaging patients before they get really sick and expensive, acting as a new front door to Teladoc's entire suite of services. In the Q&A, the CEO laid out this really clear 3-part strategy. Catapult isn't just some side business. It's being woven into the core offering. The idea is to use it to find patients with undiagnosed conditions and then guide them into their broader ecosystem of care. Okay, so with all these massive changes, pivoting BetterHelp, totally re-engineering integrated care, making new acquisitions, analysts, of course, had to ask the big question, how are you guys paying for all of this? And the concern underneath that question is pretty simple, right? It's, does the company actually have the financial stability and the discipline to see these long, complicated transformations all the way through to the finish line? The CFO's answer was pretty direct. She pointed to a really strong balance sheet, over $726 million in cash, consistent positive cash flow, and a disciplined approach to buying companies. The message was loud and clear. We have the flexibility we need to invest while still managing our future debts. So after digging through that whole Q&A, what's the big picture here? What does this all add up to? If you boil it all down, what's the one key takeaway?
Well, this isn't just some minor course correction we're watching. No, this is a fundamental, ground-up reinvention of the company's core business models, and it's all being driven by a rapidly changing market.
And this right here is the heart of it. From BetterHelp's pivot to insurance all the way to integrated care's value-based contracts, the strategy is unmistakable. The goal now is to work within the existing healthcare system, not just alongside it. This whole transformation, which was laid bare in that investor Q&A, is Teladoc's high-stakes answer to a market that is changing faster than ever. Whether these bold bets actually pay off, well, that won't just determine the company's future, it could very well shape the next chapter for telehealth as a whole.